got to uncover. And the last rule, intellectuals solve problems, geniuses, they prevent them. That's the whole trick as an investor. Get in front of the curve. Solving problems means that the problem already happened, and now you're looking for ways to fix the problem. Damage is already done. The best investors that I've seen out there, and the best mentors that I've had, have always said, try and get in front of the curve. Look beyond. Because there's always the seen and the unforeseen, and it's the unforeseen that you have to be looking at and imagining. So when you hear that, you know, oh, the dollar is weakening. Okay, what does that mean? Where do you go with that? Does that mean you go buy gold? Do you go buy oil? Because if the dollar weakens, there's going to be some other asset that goes up in price. Stocks are declining. Okay, well, where do I go with my money? Does that mean bonds are going up? Does that mean nothing's going up? You look at economic cycles or inventory cycles, and you can go into specific sectors within a market to find the right area. So what you want to do as an investor is you want to look at what's happening and try and get in front of the curve, because that's what a genius does. He looks at what's happening, he starts to think about what's the unforeseen, and gets in front of it before it becomes what it is. For you guys, it's real simple. At this point, if you want to be a genius, simplify. Simplify, simplify, simplify in this environment. Keep things as simple as possible. Focus on loss prevention. That has to be number one. How do I prevent any more losses in my portfolio? How do I prevent this from happening? Because there is. If you look at how the markets are trading right now, right here as we speak, there's a very high probability, and I'll throw it out there. I'll say within the next 3 to 4 weeks, we will see the markets go down and decline and test the lows that we had November 20th, which is about 750 on the S&P 500. Now, when you do your homework, and here's what's happening in this market. Because there are no fundamentals, there's nothing that's fundamentally good out there. There is no long-term investment thesis. You can't go buy Hewlett-Packard or IBM or Intel based on future earnings. Because each one of those companies has come out in their last earnings and said, guess what? We're not giving any projections for the future because we don't even know what the future holds. So it's hard as an investor to try and put together a long-term thesis right now because one doesn't exist. So when that happens, the big money guys, the big companies, go to technical analysis. Everybody goes to technical analysis. And unless you do your homework on things like Fibonacci's and retracements, things of that nature, you're not going to be able to enter or exit this market very well. Because the market is not moving on any common sense. Right now, it's a bunch of hyped up 30-year-old guys managing billions of dollars for firms, all sitting there playing Nintendo every day. Buy here, sell there, buy here, sell there. That's why you have the market go up 200, down 200. So they're all working off technicals. And how the technicals are breaking down right now, it's telling us that we will go see a test of that 750. Now, that test will hold, which means comes down to 750. That's in technical analysis what we call a low-risk, high-reward entry point. I'll give you a kind of a visual on that. What you have is when you have a market that declines to a low point, and you have buyers come in and it bounces up, the second time that it comes down to that point, anybody who purchased right in there, they're going to come in and double down on that purchase. Plus, there's going to be other guys that step in and make their first purchase there, because the textbook says that that first test is where we always see buyers come in. You can go through graph after graph after graph, and you'll find that that first test of a bottom, buyers always come in. It's considered a low-risk, high-reward entry point, because you come in, you buy there, and you put a very, what we call a very tight stop, 1-2% below your purchase price. And the reason you do that, because if it's an anomaly, if it's a surprise, one of the rare times that that test doesn't hold, you want out. Because if it doesn't hold, it goes fast. We saw it in November, we saw it in October and November where the market's declined almost, what, 20% in a matter of 5 or 6 days. So that's a low risk, high entry point. We'll probably see that within the next couple weeks. But here's the thing. If it comes back down and comes near there, anywhere near there a third time, everybody who was a buyer here becomes a seller right there, because their mentality changes. They were buying here out of greed and opportunity. When it rolls over or comes down that third time, the idea of greed and opportunity out the window, it now becomes, you know what, all I want to do is preserve the capital I have. I was obviously wrong. I don't mind being wrong, I just don't want to be poor. And so they start selling, and then you get another sell-off. Will that happen? Who knows? I personally think this. In 01 and 02, we had a very mild recession. It was a very mild recession. And the markets declined to that 50% mark. They bounced off and went higher. In 03, 04, 05, we had recovery. I'm not sure why we would stop at 50% in this particular market, because this isn't a mild recession. The question is, are we in recession or depression? Back in 01 and 02, we didn't have 6 banks go belly up. We didn't have General Motors, Ford, Chrysler asking for bailouts. So this environment is very different. So I wonder why. Why would we stop at that 50% mark? Why wouldn't we go down to the next level that they look at on technical analysis, which would be about 63% from the peak to the bottom? Why wouldn't we do that? That possibility is there. I hope it doesn't happen. But as investors, what we have to do is prepare for the worst while hoping for the best. And until you see those points hold, you really shouldn't be taking much risk. And you really shouldn't be listening to people who say, hey, just ride this out. Because people who are telling you, ride this out, what they're telling you is, I don't know any more than you do. And if they don't know any more than you do, what the hell are you doing paying them? If you hire an advisor, you're paying them to provide logic and knowledge that you don't have. And if they're telling you something you could have told yourself, they're not doing you any good whatsoever. So in this environment, you want to simplify, you want to prevent losses, and you want to remain curious, because there will be a turn, there will be an opportunity for you to make money. And even in this environment, there are areas that people are making money. You know, there are funds out there that actually make money. The symbol is TBT. You should write it down. It's short the 20-year. So as interest rates rise, this TBT goes up in value. Makes a logical bet in this environment. Why wouldn't you short interest rates when they're at the lowest point that they've ever been? Now, entry and exit is very important on that. So you don't want to run out there and just buy it. I would suggest that before you start looking at it, you call me and ask me about where a good entry point is on it, because it's had a hell of a run in the past few weeks anyway. So there are investments out there that our clients are making money off of, that we're bringing out to people. There's only 3 or 4 of them. But that's the whole point, is simplify the portfolio down to the 3 or 4 things that work and focus on that. And then when things improve, then we can broaden out and get more and take more risk out there. So don't stop being curious.